Hi, I'm Suzy Rhodes with Past Masters. Welcome to this week's Questions of the Week. This week, our topic is Basic Economic Concepts 1. You can expect this topic to appear on the SIE exam, Series 6, Series 7, and Series 65. We'll take a 10-question topic quiz from within one of our Past Masters Securities courses. Let's check out our learning management system. Businesses that tend to contract when the economy is expanding are called, choices include growth industries, defensive industries, counter-cyclical industries, or cyclical industries. So if the economy is growing and it's a cyclical industry, it would be growing too. But in this question, it says that these businesses are contracting when the economy as a whole is growing. Sounds a little bit backwards. Those are called counter-cyclical industries. Within our learning management system, you will click what you believe to be the correct answer. Click check answer. We know we got it right because we got that green check mark. For every one of our questions, you can click Show Explanation, and up will pop a written out explanation. You also have the ability, should you choose, to listen to every question's audio explanation. Businesses that tend to contract when the economy is expanding are... It's me! So each question within our securities course has the ability for you to read out the right answer and also listen, just to have options for the various different types of learning styles. When the yield spread widens, this is a, choices include negative indicator, sign of a coming expansion, positive indicator, or rare event. So the yield spread. What the heck is the yield spread? So there's different types of yield spreads that you could look at, but for this test, I want you to consider the cost of borrowing from 2 points of view, from the point of view of the US government on one hand, and from the point of view of a corporation on the other. So in either situation, we're going to be issuing debt of the same length to maturity. So the yield spread is this description of the difference between the cost to the US government to borrow money versus the cost of a corporation to borrow money for the same period of time. So when these are close together, so if the US government can borrow money at 2% and the corporation has to pay 2.5, that's a positive indicator. But in this question, it said that they got further apart, that the yield spread widened. So it cost the US government 2% to borrow money for 10 years, but it cost a corporation 5%, let's say. So when the yield spread widens, this is a negative economic indicator. All of the following are characteristics of growth industries except, this is one of those questions I want you to reword in English without the except. So I literally suggest writing this on your scratch paper without the except and then reading it. There's something about reading it without that negative that it just makes more sense in your brain. So let's see, how could we reword it? Which is not a characteristic of growth industries. High dividend payout rates, not a characteristic of growth industries. Growth industries pay low to no dividends, but let's check the other three. So we know the other three should be, if we got this question right, characteristics of growth industries. Volatile stock prices, that is a characteristic of growth industries. Low to no earnings, yes. Low to no dividends, yes. Now, there's another hint here in this question. When you have two answers that contradict each other, you know one of those two is going to be the right answer most of the time. So we are looking for what's not a characteristic, high dividend payout rates. The true statement is growth industries pay low to no dividends. Who is responsible for fiscal policy? The President and Congress, the Federal Reserve, taxpayers, or Congress only? Fiscal policy is budgetary changes in tax code. Fiscal policy is set by the President and Congress. The other type of policy the test is going to care a lot about is monetary policy. So who controls the money supply? Yes, that would be the Federal Reserve. All of the following would be tools used by the Federal Reserve to fight inflation, except, rewording it without the except, which is not a tool used by the Federal Reserve to fight inflation. So let's think about inflation here for a second. Depends upon what's happening in the economy, but if you go to the gas pump and things are getting more expensive, what's that? Inflation. So milk is more expensive. Everything seems to be, housing is more expensive, right? During a period of inflation. So too many dollars chasing too few of goods is one of the root causes of inflation. So if the Fed is going to fight inflation, we're looking for what is not a tool to fight inflation. So 3 of these will be tools that the Fed uses to fight inflation and 1 will not. So that's how I would approach this question. The securities test is not a race. You do not get a gold star for finishing as quickly as possible. You get a gold star when you pass these exams. So I'm not saying disregard your time. I'm just saying don't rush yourself. Take your time. Choices are selling U.S. government securities, raising the reserve requirements, buying U.S. government securities, or raising the discount rate. So we're looking to 3 things fight inflation and 1 does not. Raising the discount rate would make money harder to get, which means there would be less loans being given. This would be a tool to fight inflation. Raising the bank's reserve requirement would also mean the banks have less money to lend, would be a tool that the Fed would use to fight inflation. So that leaves us with 2. So this is one that I have to just write down and work through with you. So if one of the root causes of inflation is too many dollars chasing too few of goods, and we're looking at monetary policy, so set by the Federal Reserve. And one of the tools of the Federal Reserve is the buying and selling of U.S. government securities through their open market committee. So open market operations, the buying and selling of U.S. government securities. So we have 2 things to look at: buying and selling of U.S. government securities. So in this question, we have inflation. So too many dollars in the economy. So we want which of these tools to pull dollars out. So if the Fed sells U.S. government securities, so the securities go into the economy, and what comes out of the economy? Dollars. Is that what we want to do to fight inflation? Yes. So the selling of U.S. government securities would be a tool used by the Federal Reserve used to fight inflation. So when we are in an economic contraction, the Federal Reserve oftentimes will embark on what we call quantitative easing. So the selling of U.S. government securities is called quantitative tightening, getting the money out of the economy. If we want to get the money into the economy, then the Open Market Committee is going to buy U.S. government securities. So I always draw, it seems really cheesy, I know, but use your scratch paper, try it. I think it will really help. So when they buy US government securities, buy securities, the securities come out, but what goes in? Securities come out and dollars go in. So the buying of US government securities is done to fight a contraction, a recession, a depression, whatever they want to use on the test. So buying of fights a contraction, selling fights inflation. So now let's go back to the question. Selling fights inflation. So selling US government securities would be used to fight inflation. Buying US government securities is done to stimulate the economy. So buying US government securities is going to be the correct answer to this question because it is not a tool used by the Federal Reserve to fight inflation. So I know that was a lot for that question, but I've been doing this a long time with students just like you, and I know this is one of those kind of sticky topics where it takes a little while to kind of sink in, and hopefully you can always rewatch the video a couple of times to get that. They love these tools on these exams. You got it. Which correctly identifies the proper order to the phases of the business cycle? So there are 4 phases to the business cycle. They always go in a specific order. Expansion, peak, contraction, and trough. That is the order. So always questions here. Let me show you what this looks like. So we know the 4 phases of the business cycle. What we do not ever get to know, unfortunately, is how long is a phase going to last. So we want to live it perpetually in an expansion. I mean, I know I do. So expansion, sometimes called recovery. It's when the economy is growing. When you hike to the top of a mountain, eventually you get to the peak, the top, and then have a little snack, check out the view. What are you going to do? You're going to hike back down. So contraction, expansion, peak, contraction always follows a peak. Tess loves the order. And then the trough. So you don't know how long any of these phases is going to last for, but you do know the order. What follows a trough? Expansion. What's after the peak? Contraction. What's after the contraction? Always the trough. Expansion, also called a recovery. Contraction could be a recession or a depression, depending upon the length of time that it lasts for. Keynesian economists believe that choices include higher taxation and less government spending should be used to get the U.S. out of recessions. Lower levels of taxation and higher government spending can get the U.S. out of recessions. Less government spending is key to stoking the economy out of a recession, or the quantity of money in circulation determines our ability to rise from a recession. Keynesian economists believe in lower levels of taxation and higher government spending, that those tools can get the U.S. out of a recession. So it's never which one's right, because trust me, economists will argue about this forever. It's just, do you know a little bit about the different economists' points of view? An inverted yield curve. What's that? Let's look at it before we look at the rest of the question. So when we have a yield curve, we're looking at the yields. There's different ones you can look at, but for the test, we're going to look at the yields on U.S. government securities. So we're going to look at Treasury bills, we're going to look at Treasury notes, and we're going to look at Treasury bonds. And a normal or positive yield curve has an upward slope. So a Treasury bond has the longest term to maturity, up to 30 years, and investors are going to demand a higher yield on a long-term instrument. That would be normal. If they were all about the same, we would call the yield curve flat. But this question was about a negative sloping yield curve, also called an inverted yield curve, where the yield on the short-term Treasury bill, 1 year or less to maturity, is highest. The Treasury note is lower and the Treasury bond is the lowest yield. So that's not normal. It's backwards. So let's check the question. An inverted yield curve is caused by a decrease in short-term interest rates. No, it can be caused by an increase in short-term interest rates, however. Slopes upward? No, it slopes downward. Is flat? No. Can be the result of high current demand for money relative to supply. So that is correct. So there can be two causes to this inverted yield curve: an increase in short-term interest rates or high current demand for money relative to supply. It has historically almost always been a precursor to a recession. So they look a lot, economists look a lot at the yield curve. Increasing business activity is found during a peak, trough, contraction, or expansion. So where we have growth in the economy, that is going to occur during an expansion. Which of the following is most cyclical? So cyclical, following the business cycles, expanding during an expansion, contracting during a contraction. Choices include appliance manufacturers, utilities, pharmaceuticals, or packaged foods. So some will be counter-cyclical, which work the opposite, expand during contraction and contract during an expansion. Some are defensive, which means they resist market cycles. So of these, the most cyclical, I mean, look at your own life. You heat your home, you take your prescription drugs, those are defensive. Packaged foods, you still have to eat. But when are you going to buy a new washing machine? During an economic expansion or contraction? During an expansion. Appliance manufacturers would be the most of those choices, the most cyclical. That's this week's Questions of the Week, Basic Economic Concepts 1. Be sure to give this video a thumbs up if you learned something, subscribe to our channel if you're not a subscriber already, and turn those notifications on. If you have any questions at all about this topic, just ask me in the comments below. If you'd like to check out our Past Masters Securities course offerings or to enroll in one of our courses, there is a link found in the description to this video. I hope to have you as a student soon. Happy studies! You got this.